license as well. The more you learn, the better at the end of the day. I want to give a special shout out to Alina. Happy birthday to Alina as well. And yeah, let's get started. So, Daniel, floor is yours. You can go ahead. I am going to spotlight you as well, okay? All right.
Perfect. Thank you very much, everybody. Thank you for coming on at 8 p.m. on a Tuesday. So today, I want to talk about the markets with you guys a little bit, but news-wise, there's not too many things that are new yet. Obviously tariffs are starting, stopping, coming on, coming off. What I want you guys to focus on really when it comes to investments are overall what's going on in the markets. So, one of the most common questions that I've been getting is, what do I do now? Markets are down 10%. So for example, let me pull up. I wanted to show you guys something here. SPX. Let me share my screen. Would you allow me to share screen, Param, please?
Yep, go ahead. Yeah, you'll be able to share now.
Beautiful. Thank you. Thank you. So how many, I guess, I want you guys to stop looking at what's going on in the markets as it's a 10% drop, because it isn't, quite frankly, not yet, at least. Year to date, for that matter. So if we take February 19, the highest point, the absolute height that the stock market has ever been at. Yes, 1 second, let me go back to the shorter one. Yes, it is a 10% drop, but we have already recovered somewhat, right? So when your clients call and say, market's down 10%, this and that, the fact of the matter is that's not the reality. Year to date, the markets are down 4.3%. Unless your client, you or all of your clients started investing on February 19th, they are not down 10%. And quite frankly, if they're going to take this perspective of I'm down 10%, well, maybe in that case, we should consider when they started investing. If they started investing with you 5 years ago, their return is incredibly good over that 5-year period. So they're not really down 10% or 5%, right? They're down a little bit, but they're still up overall. The reason you're hearing a lot of markets down 10%, this and that is, well, because it catches headlines, right? It sounds worse than it actually is. The fact, again, like I said, fact of the matter is the reality of what we're seeing right now is the year-to-date number is only 4.5%. If you or your clients are worried about a 5% drop year-to-date, you are invested way too aggressively, right? So what I want you guys really to think back on is, what do you do when the market is down? Does anybody remember what you do when the market is down?
It's on sale.
It's on sale. So you want to be buying more. The last thing you want to be doing, so I've been getting a lot of calls, a lot of questions about, hey, should I sell? Should I be moving out of the market? Should I be, selling my Canadian stocks? Because if we get tariffs, Canada's going to be very affected. Should I be selling my US positions because the US is going to go down because of tariffs? I don't let short-term problems affect your long-term investment strategies, right? Just to give you guys some perspective. In 2022, should you have sold everything because interest rates went up and the market fell 35%? No. During COVID, when the world stopped, We had one of the sharpest, fastest recessions we've ever seen in our lives because 30 to 40% of the world was just not leaving their homes. Should you have sold everything because we didn't know what was going to happen? No. Even if you go off a little bit further back, 2018, Trump had a trade war with China. He started implementing tariffs against China. Should you have sold everything, panicked, and sold out of the market? No. 2016, and between 2014 and 16, should you have sold all of your Canadian equity positions because oil fell a lot and essentially our stock market was severely affected? And the reality is 35% of the stock exchange in Canada is oil. Should you have sold all your Canadian positions? No. 2008. Should you have sold when the market was down 50%? I can go back and back and back and back. And the worst one, actually, quite frankly, is this one. The NASDAQ. In 2000 to 2001, we had what's called the dot-com bubble. The DAC, which is what the NASDAQ is, the DAC follows the NASDAQ, which is an index, fell about, in total, at the worst point, it was about, I think it was 79 or 82% negative over a roughly 2-year period. Now, that one's a tough one to swallow because you only made your money back 15 years later. So it took a very, very, very long time to recover. But point being here is, during my presentations, and I'm sure other product provider partners have said this exact same thing to you guys, when the market is down, you do not want to be selling. The time for selling has already passed. Like if somebody wanted to avoid a market downturn, the time has already passed. The issue with that is, how do you know when it's going to happen? Right? Like if your clients had called you and said on February 7th, 10th, they called you and said, hey, I need you to sell all my investments. I think the market's going to fall. All the money in the world should be invested with that one person, with that one client you have. And that's really not an exaggeration. So, what I want you guys to think of investing, as far as when to buy, when to sell, opposites. You always want to be a contrarian. When the market is down, you want to be buying. When the market is up, that's when you can be selling, but you still don't want to. Why? Because what happens if, 2000, let's just look at this point. Let's say you sold here, August 28th of 2020. How do you decide to get back in? At which point do you say, wow, the market is low enough that I want to buy back in? And then it takes off. So it's not that I can spend 5 hours talking about why we shouldn't sell, why we should remain invested. But really what I want you guys to have, and the perspective that I want you to have with your clients, is the reality is NASDAQ fell significantly more, but obviously it's going to fall more. It's a lot more concentrated. But the overall markets haven't really fallen that much. The S&P 500, 4.3%. TSX, where is it? What are we at? Year to date, flat, essentially, for the TSX. Pretty much the same, right? Europe is actually up about 11% in the year, right? And a lot of that, I hate to give credit here, but a lot of that is because of Donald Trump. He's essentially causing the reindustrialization of Europe by telling the European governments that the US will no longer pay for their security and that they need to pay for their own security. So that's what's moving a lot of reindustrialization within Europe. that they need to have their own weapons manufacturing, and they need to increase spending themselves and not have Americans pay for it. There was a very interesting quote from the Polish president. He said, it doesn't make sense that 500 million Europeans are asking 300 million Americans to defend them against 180 million Russians. It just, and quite frankly, the problem is more so defense spending needs to be done in-house. Obviously, Europe was rebuilt by America, which is really good, of course. But now there's a big push for the US to try to defend the other side of the world against China. This is really the strategically, this is what seems to be happening. They're trying to focus more on one side of the world and allowing Europe to take care of the other side of the world. So, from that perspective, we need to make sure that we're also very well diversified. We want to be investing in Canada. We want to be investing in the US. We want to be investing globally. But we also have to keep in mind this different sizes of the stock markets. For example, the US stock market makes up about 60% of the global stock market. Canada makes up about 2% of it. Europe makes up another 15 or 20%, and then it's the rest of the world. So, when we think of how we want to invest, we definitely want to be allocated all over the place. We want to have some diversification. But we also want to make sure that we invest in the highest possible quality investments. And for better or for worse, the S&P 500 or investing in the US is really one of the best places to be investing. You have the best companies in the world. So for today, as far as the market update, like I said, there's really, as far as new things, there's not much new. Interest rates were cut in Canada last week by 0.25%. In the US, we will likely not see a rate cut in the very near term because we're seeing inflation resurgence. We saw a lot of inflation resurgence as well in Canada. So now as well, obviously the tariffs are the big problem. And I'm not sure if you guys are following what's going on in the US, but there is now a real fear of recession, which is what triggered all of this sell-off. So there's the central bank of the U.S., which is the Federal Reserve. They came up with this new algorithm to calculate or do forecasts and estimates of GDP in the U.S. It's called, I believe it's GDP Now. It's called this new formula that they have, and this new formula that they have has. Before in February, it had an estimate of the first quarter growth of the U.S. being 2.6% for the first quarter. So that, the estimate was for January, February, March. They do the estimate monthly because they get new data for the estimates. They did the most recent estimate. I believe it was released on March 6th, and early in February, like I said, they had expected potential growth in the U.S. of 2.6%. They did it most recently in March, and now they're expecting negative growth of 2.6% in the U.S. That's what's started to trigger a lot of the sell-off that we've seen in equities in the U.S. in particular. So we have seen a bit of a correction. A correction is classified as a market drop of 10% from top to bottom. But again, one thing to keep in mind here is a correction versus a recession or a bear market. They're categorized as very different items. A correction is categorized, like I said, 10%, a 10% drop in the market. But they're categorized as something, or they're distinguished by the fact that they're very fast, very, very, very fast. Whereas when you have a bear market, like we did in 2008, 2001, they're a lot slower. It takes months, years even for it to play out. So we've seen a very, very fast decline in American equities, and which is more importantly, we have now seen a big enough drop in a lot of different companies that now they look extremely valuable, extremely well valued. So a lot of clients, a lot of investors are pouring money back into the markets to be able to buy these companies up. Most recently, we were on a call with one of our portfolio managers. It was last week, actually. He was saying that there is, of course, the potential risk of what may or may not happen in the near term. It's all going to depend on the growth numbers that we see in the U.S. And inflation is going to be another very large gauge of that. But I want you guys to keep in mind one thing. If we do have a recession in the US, and in Canada, as much as it would be really bad, it would come with some positives. It would help us get rid of inflation. Very good news. Better news, or sorry, and what's some bad news? Market would fall a lot. How much? Your guess is quite literally as good as mine. But from a good news perspective, we have central banks who have shown us that they are extremely willing to change interest rates very, very quickly to be able to stimulate the economy and have a rebound, because they don't want to see prolonged recessions. So, really, really important for us to keep that in mind for what we're seeing in markets. Yes, things can get bad, but if you look back to what's happened in the very recent past, we've been kind of really, really fortunate with what we've seen in the last, particularly 15 years, right? Market rebounds have been incredibly fast, and they have come back much, much higher every time. And one other thing to keep in mind is I think we've gotten used to markets really only going up in the last 5 years, and again, particularly 15, but in the last 5 years in particular. We should not be concerned about a 10% drop, 5%, 10%, even a 20% drop. Again, if you are concerned about that, you are invested way too aggressively, right? Because when we do investor profiles, when we talk about investment, we talk about risk, we want to make sure that our clients understand if you're going to be investing in all equities, if you were happy to get 40% last year, you should be okay with getting 10% down the next year, 20% down. 30% down. The fact of the matter is, if you got 40% last year, you should be okay with getting a negative 40% at some point in your within your investments. It's not ideal, but it's not anything that we can control. Now, the good news, and to give you guys a little bit of peace of mind about what to do. Your job as an advisor is not to guess what's going to happen in the markets. Your job as an advisor is not to move money around so that your client's money only goes up. Your job as an investment advisor is to take my money as a client, invest it according to my risk tolerance, and that's it. If the market goes up, fantastic. If the market goes down, fantastic. It's a buying opportunity. So, always please keep in mind the perspective. Look at this graph long term. It's really just growing, and it's going to continue to grow. And a very, very important thing to keep in mind, when it comes down, what is it followed by? A significant increase again in the market, right? Things don't just run, right? So, for example, this analogy that I've been using because I'm preparing for a marathon, so I want to use this analogy. If you have a marathon, you're going to run 42.5 kilometers or something like that, something that I don't know why I signed up for it, but anyway, it's neither here nor there. Can I sprint the whole way? No. Quite frankly, no. Right? What happens? There is exhaustion. The same thing happens in the market. Market's up. It's got to fall for it to be able to recover and go higher. It goes higher, then it comes down a little bit, and then it's going to keep going higher. Will we continue to see more the market fall more this year? Quite frankly, I don't know. Like I said, your guess is quite literally as good as mine. However, what I do know is that once it stops going down and it continues to go back up, when it goes back up, it will be up much more significantly than it was before. Why do I know this? Because this is simply what has been the trajectory over the last 100 years, right? If that wasn't the case, people would have stopped investing in the stock market years ago. The stock markets have been around for hundreds of years at this point. So what I want you guys to keep in mind is perspective. Don't let your clients panic, your clients' fear roll over into your mind. As an advisor, your job is simply to invest. That is it. Buy and hold and buy and hold. If the market falls, you buy more if you can. And this is why I always suggest, you want to make sure that you have a pack set up for every single one of your clients. It's a really, really good strategy for you to be able to have, take advantage of when the market is down. Now, there's one thing that that I want to share with you guys. 1 second. Sorry, it closed on me. There it is. And so over the last 5 years, particularly over the last year and a half, 2 years, I've been suggesting to, 1 second, guys, sorry, this thing's not, there we go. As an advisor, I want to suggest something to you guys. There it is. So don't focus on the funds. Again, I want us to focus on the asset allocation. Balanced, 60-40, growth, 75-25, and so on. My suggestion, I would recommend being more conservative than aggressive right now. And I've been suggesting this over the last year and a half. I'm pretty sure I covered this with you guys. Does anybody remember why? The answer is there's something between stocks and bonds that's going on right now. Stocks are at an all-time high. They have never been higher, ever. Companies have never been valued higher. There has never been as much growth in the stock market, ever. Bonds, however, I'll show you guys the graph actually, so that just in case you guys don't believe me, are zag.to. There it is. Bonds, on the other hand, are at a 25-year low. Why? Because when interest rates go up, bond prices fall. So we have a generational opportunity to make a really good, to essentially buy into a very, very low risk trade with bonds. My suggestion is be more conservative than aggressive. Like I was just showing you guys here, the stock market, all-time high. It has, like I said, never been higher. And this is all stock markets pretty much across the board in the world, right? So if you're planning on investing your client's money, let's say in a aggressive portfolio, consider, instead of doing 100% equities, doing 10, 15% into bonds. If you're going to be doing a growth portfolio, consider doing, instead of 75-25, actually 75-25 is probably fine, but consider doing 70-30 even, right? Why do I suggest this? So that when we have market downturns like we have right now, you can move money from bonds into stocks. It's a huge opportunity for us to be able to do that, right? So again, we can't guess what's going to happen in the market, right? I can't. Even if a client told me I think the market's going to fall, I would have said remain invested, right? 3 months from now, when the market's much higher, it's going to be a negligible. Everybody's going to forget about this. But right now, it's what everybody wants to talk about, right? Short-term problems should not dictate our long-term investment strategies. But again, I want you guys to always be looking for opportunities. And a really good opportunity right now, like I said, is buying into bonds, because bonds are not only going to help provide you some safety, some income within your portfolios, but it's also going to be able to give you what we call powder, dry powder, cash, essentially. An asset that is not going to fluctuate as much as stocks, so that you can sell them and add more into your stock position. Let's say the market does fall 50%. If you have a growth portfolio, you have 25% that you can reallocate into stocks that are 50% down. Would I do it right now when the market's down 10% or so from top to bottom, from top to where we are right now? Maybe. I would add 5%, maybe, but I wouldn't do a big change. You want to reserve these changes for when you see big market moves. You don't want to be doing it all the time because, quite frankly, one, you're going to create a lot of work for you. One. Two, you're going to be changing the composition of the portfolio all the time, which is a problem. And three, it's not sustainable, right? Because 5% drawdowns are extremely common. 10% drawdowns or near 10% drawdowns are extremely common, right? So you're going to be creating a lot of work for you and potentially an expectation from your clients. If you see the markets, though, down 25%, by all means, make a switch. It's a really good strategy for you to be able to help your client, help grow your client's money a little bit faster and make more money in the recovery. Okay, so I'm going to pause there for a minute, a couple of minutes. I shared a lot. What is going on with you guys right now with clients that I can help you with? What questions are you getting? What questions, what concerns do you have individually, and not only as an investor but as an advisor? How can I help you guys?
Everyone, you can unmute yourself and just share or ask any questions you might have for Daniel as well. So, Daniel, if I could give you a question, a
Please.
lot of times we meet a lot of clients that have a TFSA, they have a FHSA, or they have RRSPs, but they just have it sitting around in the bank and it's in a GIC. It
Yeah.
might be like at 2% or 3%.
Yeah.
How do you start a conversation with them that, hey, you know what? What's tax free about a tax free saving account? It's the growth. If your money's not really growing,
There's no point.
what would what's the point of having a TFSA? There's really no point, right? So
Exactly.
something along those lines.
So it's a really good question. I actually, before leaving TD in my last year there, I moved about $17 million from the GIC only client into the markets. And it was a very simple conversation. So, the number one thing you're going to want to do is ask the client, what's the goal for this money? What is the end use of this money? Whether it's retirement money, whether it's buying a home money, whatever it is. Because a GIC is really just a savings account, is really, quite frankly, what it is. Buying a GIC is like putting your money into money market or high interest savings. I'm sure we can all agree that's not a good idea for a long-term investment vehicle, right? What I would suggest is really try to understand your client's goal, their objective. A lot of them normally are going to say, at least with the clients that I was dealing with, the most common answer was, oh, it's to supplement my retirement. Perfect. Great. You want to use it as income. Fantastic. You're not growing your money within a GIC. You're just not. Usually you're just tracking, if not, you're right under inflation. So you're not growing your money at all. You're just essentially staying at zero. You're the zero growth pretty much permanently. What I want you guys to do is, one, have a risk conversation with them. Try to understand why they use a GIC. The most common answer is it's safe. It's safe. I understand it. It's safe. It's safe. The most common answer, right? Do you guys know what is safer than a GIC? Does anybody know? I've already talked about it today, actually. Bonds. Bonds are significantly safer than GICs. let me show you guys how and why. Actually, one second. Oh, actually, I can share. I can do this one. Let's pull up our. There we go. Let's do Canadian corporate bond IA. So I actually moved. Let me show you guys what I did. So I moved it, like I said, about $17 million from GICs into the markets. What portfolio did I use? This, the conservative portfolio. Either the conservative portfolio, so 80% stock bonds, 20% stocks, or all bonds. Those were my two options. Why? Because I don't want them to have large fluctuations, right? Obviously, they're a GIC client. They cannot handle a balanced, a growth, or an aggressive portfolio. They just can't. For better or for worse, they just can't. So what you first want to start the conversation by is, like I said, one, try to understand why a GIC. Like I'm not even saying like just ask why a GIC. Like obviously that's where the conversation starts, but try to really, really get into the detail. Why a GIC? It's safe. Okay. What is safe about it to you? Why is a GIC safe? Like really try to understand the psychology behind safe. Because, oh, it's guaranteed by the bank. Well, only $100,000 of it is guaranteed by the bank. Well, I know that I'm going to get my 3% or my 2% or my whatever percent every year. Great. That doesn't give you anything, but perfect. Fantastic. What I want you guys to consider is, again, really understand. That's step number one. Like you need to you need to go deep with this. And the reason I say that is because once you understand what makes them tick, what it is that they have fear about, this and that, you can introduce bonds at this point. Why are bonds safer? Because bonds are guaranteed by the issuer. You could put $100 billion into a GIC, only $100,000 is guaranteed from that GIC. You could put $1 trillion into a bond fund, and every single dollar is guaranteed by the issuer. Who is the issuer? Manulife, Intact, the pipeline, this company, Enbridge, TD.
Daniel, which fund is this?
This
What's
is
it called?
Canadian corporate bonds. So this particularly invest in corporate bonds. The reason I really like this bond fund is because it has a very high credit quality rating, so A minus, really, really high. The average term, so clients understand terms, right? What you want to do now, before you go into all this information, is explain how a bond works. So let me break it down for you guys. Let me pull up a different document. I'm going to pull up a Word document for you guys. So this is, if you guys are going to take notes at some point today, this is when I would suggest taking the notes. One second. There we go. Okay. Let me get rid of this. Bonds. How do they work? So a GIC, you give the bank 500K, and they give you a 1-year term, and let's just be super generous, 5%, right? So what happens to your bank account? Bank account minus 100K for 1 year. GIC to bank plus 100K, right? In 1 year, after the 1 year, bank returns 100K plus 5% equals, there we go, $5,000, right? To 105,000 actually. Simple, right? Simple math for everyone. 1 year term, you can do it. 5-year terms, doesn't matter. The value of your GIC will never fluctuate, correct? Never. That $100,000, the stock market, the bond market can go minus 50%, and the value of that GIC that you put in is never going to change. Bonds, on the other hand, fluctuate with interest rates. If interest rates go up, bond prices go down. If interest rates go down, bond prices go up. Simple. Everybody with me so far? When a bond is issued, it has terms. Let's say the government of Canada, or let's say IA. IA needs $1 billion to build a new head office. How do we get that money? We can take a loan, we can issue more stock, or we can issue bonds. Bonds are effectively loans. So let's say we do a 10-year bond for, we issued $1 billion, $1 billion of 10-year bonds. So we're issuing a lot of bonds. It's not one bond. We're issuing thousands, hundreds of thousands of bonds, correct? And we are going to pay, let's say $3 per bond. $3 per bond. Each bond is $100, meaning we will pay 3%. Everybody with me so far? Simple math so far, right? Now, what happens if interest rates, let's say they shoot up? We go from, let's say we're sitting at what, 2.75 right now. Let's say for whatever reason, interest rates go to 10%. We have, a crazy amount of inflation. I don't know, whatever happens. We go to 10%. Each bond, so just so that you guys know, each bond is worth, the face value is $100. Face value is equal to $100. Interest rate, we call coupon, is equal to $3. As a ratio or percentage, this is equal to 3%. If, let's say, interest rates go up, the value of the bond goes to $50. $50. It still pays coupon of $3. $3. Okay? As a ratio, you are now getting 6%. Everybody with me so far? Simple math, right? Because we are now the value of the bond is 50. If you buy more now, you're still getting the $3, but you're getting $3 off of 50. So as a percentage, it's 6%. Everybody with me so far? Okay. Now, the really, really, really important part here, and this is what I want you guys to take away from all of this. If throughout the whole time, the value of these bonds until maturity stays at $50, when they mature, the bond holders get back $100 per bond. Does this make sense for everybody? So I'm gonna explain this in a different way. Let's say mortgages could fluctuate in value. What you owe to the bank has not changed, right? Let's assume, you can go into receivership or you can declare bankruptcy or whatever the case may be, and you maybe no longer have to pay the full value of it. But what you owe to the bank is still the mortgage amount. So it doesn't matter what happens to the bond in the middle. It can fluctuate up, it can fluctuate down, it can do whatever. But at maturity, bonds always mature at par. Par is $100. So this is why bonds are so safe. Because just like GICs, when they mature, you get all of your capital back guaranteed. All of it. Every single bond is going to have that, it has that built into it. That is simply how they work. They are a debt instrument which has to be paid back to the person who's holding it. Okay? So once you explain this to your clients, and now moving away from this, right here, for example, we have 8.2%, or so 8.2 years, and we're going to get 4.8% for the next 8.2 years. So these bonds are going to be paying 4.8% for the next 8.2 years. In 8.2 years, this whole portfolio is going to change. This bond fund is pretty much going to have to buy a whole new set of bonds. So this is why bonds are safer than GICs, because it has unlimited guarantees. The one thing that you will have to make sure that you explain to your clients is fluctuation. They will fluctuate. Unlike your GIC, they will fluctuate. You can see here in 2022, negative 10%. 2021, negative 1.25. But you can see overall, the rates of return are always quite significantly higher than a GIC. Significantly higher. So this is why we want to make sure that we can, essentially, we don't want anybody in a GIC is quite frankly what it comes down to. Unless, you're buying a house in 6 months or 12 and exactly 12 months and, we got to get you that money at that point. Sure, fine. That makes total sense. But in an ideal world, we don't want anybody really investing for the long run in a GIC. We want to be able to have them in at least bonds. And, one of the things that you can show your clients as well is, let me see if I think I still have this comparison up here. Fund codes. One second. I did a comparison of funds. One comparison. Yeah, there we go. So I did a comparison for a client a while back. Where are you guys? There you go. Showing the client, had they invested their $600,000 in bonds instead of GICs, how much money they would have today. So what I've done here is, because you can't compare GICs, they're just not market securities. What I did is I took a money market fund. Money market tracks interest rates, just like GICs. When GICs were paying 5.5%, money market funds were paying 5.25%. So it pretty much just about tracks it. Maybe even add 0.5% if you want to be generous. But you can see here what happens with $600,000. The red line is the growth of bonds since 2002. The blue line is the growth of your money within a GIC since 2002. It's a drastic difference. So number one, the most important thing, again, going back to the original question, is try to understand what your client is using their money for. What is the end goal? Why are you investing? Oh, this money is for this money that's in a GIC is for retirement. Perfect. Are you collecting an income from it? Yes. No, not yet. Why a GIC? And again, details matter. We don't want we don't want to add risk to our clients' portfolios. We don't want to just give them more risk. We want to educate them at the better opportunities that are out there and available to them. A GIC is just, quite frankly, like I said, really not going to make a difference for anybody's portfolio. It's not going to benefit anybody. That's why we want to be able to have our clients move them into some sort of portfolio solution, at least bonds. Bonds will at least provide them a much higher level of growth over the long run. And again, they are safer. They're guaranteed by the issuer. So when you guys have these conversations, please make sure that you want to focus around the objective of the client. Because if the client has if they're using it as income, the only thing a GIC guarantees is that you're going to run out of money. Quite frankly, that's what the G stands for, guaranteed running out of money, effectively, right? Because you have no growth. It's extremely tax inefficient as well. So let's assume we're a non-registered example. Even if the bank can give you 6% for 1 year, great. What do you do the next year? You're probably going to get 3%. And you have to go back into the bank. You have to go negotiate. You have to go do this and that. It's a waste of your time. It's very tax inefficient. Even, like I said, even if they give you 6%, half of that is going to taxes, right? Whereas with interest, with bonds, you're getting interest as well as capital gains. And capital gains, as we know, are by far the most tax efficient way to get taxed. So let me show you guys a different graph. When you receive interest from a GIC, you're getting taxed here. When you receive capital gains, you get taxed here. Very, very, very different scenarios. So obviously, we want our clients to keep more of their return, right? If I offered you an investment that's 10%, but you have to give up half of that return to taxes, would you rather have that, or would you rather have 8% return, but you get to keep 85% of your return? Pretty obvious what you're going to do, right? If I can offer you the same thing, if not better, but with less risk, would you take it? Yes. Bonds are a really good solution. One of the ways that I explain this to clients, now to really boil it down to a very simple example, is imagine you buy a condo for $100,000. One of them is going to pay you $3,000 a year in interest. And every single year you have to go in and renew that rental agreement. And 90% of the time, your rent is going to renew lower. The value of the condo will never go up. It will never go down. But 90% of the time, every year, your rent is going to go down. Okay, that's option one. Option two is you buy a condo. The value of that rent stays fixed for 8, 9, 10 years, depending on the length of the term that you agree on with the renters. And the value of the condo can go up and it can go down. But 90% of the time, 80% of the time, it goes higher. Which one would you choose? Right? And the beauty of explaining it this way is that people understand real estate. People are, for some reason, as soon as you explain, interest coming from bonds as well as capital gains, they get lost in the fact that it's no different to, interest is the rent. Capital gains are the increase or decrease of the value of the condo. It's the exact same thing, right? So that's why, again, always relate it back to a simple way for them to understand it. And that simple way is always going to be using real estate, because the structure of it is really, quite frankly, it's almost the same. So there's 6 more minutes left. I think I took up like 15 minutes on just that one on that one question. But it's really, there's a lot to go over with that one in particular. Like I said, really, it's about explaining to the clients the value of changing from GICs to bonds.
Awesome. Thank you, Daniel. I think that answered the question really, really well. Another thing I was going to mention, everyone on the call, if you can, just make some notes because you'll come across a lot of clients that have TFSAs, have RRSPs, and they have it sitting around in the GIC. Number one, if it's in the GIC, only $100,000 is guaranteed. That's something that Daniel already mentioned. Okay, so you should understand that as well. Generally, bonds are safer than GICs, just as Daniel explained as well. And also, they have a higher return as well. So, those are things that you should note down because a majority of your clients that you come across can actually, will probably be in GICs as well. I know Amira, you just messaged. Can we take a snapshot of the bonds notes?
Yeah,
Daniel, you still have those notes? If you
yeah, I've
can
got them
throw them
up.
up and
Yeah.
awesome.
Please, everyone, just grab your CE credits. I'll just wait a quick minute here, and then I'll go back to the notes with the for the bonds.
If
And
you're
really, just
licensed, please take a picture of the QR code.
yes, yeah. Just try to think of them as GICs that can fluctuate. That's
Well,
really the easiest
Daniel, I
way.
am on my phone, so I don't know how to take a picture of QR code.
Don't know. That's a tough one. Can anybody text her the QR code?
Take a screenshot.
Or can anybody text her the URL?
You can take
Yeah,
a screenshot.
Harji, I'll send it to you.
Okay, send the link in
Okay.
chat. Okay.
I'm sending it to you right now.
You send the QR code?
No, the link to submit. So
Yeah.
I just sent it to you on WhatsApp.
Okay, yeah, thank you. Yes, thank you.
All right, everyone, you can take a screenshot of the bonds notes now.
So this is the main takeaway. When they mature, bonds always mature at par. When they mature, bonds always mature at par, which is $100. So
All right.
the beauty of this is, again, I'll just recap this part right here. If you buy more bonds at $50, you have a $50 potential capital gain. It's a huge potential gain with bonds. So again, really good opportunities right now in the bond market because it helps minimize the risk in the portfolio a little bit even. Okay. I hope everybody got some C credits. I hope everybody learned something new today. Thank you very much, everybody, for your time. I really appreciate it. Of course, anytime, if you have any questions about anything we covered off today, please feel free to send me a message, give me a call. We can always have another call like this anytime. And I will see you guys again soon.
All right, Daniel, thank you so much for sharing with us, and we will see you again.
All right, take care, guys.
Awesome.
Thank you,
Good night,
bye.
everybody.
Good night.